On this board, we're talking about interest. This is so very important because the concept of interest is at the foundation of personal finance. So that's why we're starting this financial literacy course with this video on interest. Now, let's clarify, what is interest? What exactly is interest? Well, interest is the money you have to pay for borrowing money and the money you earn for lending money. Let's jump right into our first example. Example number one is, let's say someone takes out a car loan at 10% APR, right? Now, what is APR? APR is annual percentage rate. It is the percentage of the principal that you are charged as interest for each year during the life of the loan. Okay, so example number one, someone takes out a car loan at 10% APR, 10% annual percentage rate. Now, let's say that the total cost of the car is $16,000, and let's say they put a down payment of $4,000. Now, what does down payment mean? Okay, down payment is the money paid up front. Okay, so total cost of the car $16,000, the down payment $4,000. Okay, so how much is borrowed then, right? Right. So they're buying a car for $16,000. They're putting a down payment of $4,000. So that means they are borrowing $12,000. The money borrowed is $12,000. Okay. Another term that you're going to hear a lot is the amount that's financed. All right. So another way of saying this is that the down payment is $4,000 and they are financing the remainder, right? Which is $12,000. So basically, that means they are borrowing $12,000. Okay, it means that the loan is for $12,000. Okay, so let's look at this. So as I said, money borrowed, it means the money that was financed. Okay, so let's look at this chart. So we start at the beginning. We owe $12,000. $12,000 is the loan, right? Because $12,000 is the amount that's borrowed. $12,000. Now, let's say that they are paying $200 a month. Okay. Let's say their monthly payment is $200. Okay. So $12,000 is the loan. The monthly payment is $200. All right. Let's calculate how much is going towards interest and how much of that is going towards the principal. Okay, let's clarify a few terms here though. Principal, what does principal mean? The principal means the amount of money that is owed. Okay, and as you pay down the principal, right, then that means the principal balance is getting smaller and smaller. Okay, as we're going to see soon. All right, now and interest, how do you calculate the interest? How do you calculate like the monthly interest, right? Well, you take the principal, right, which is the amount of money that is owed, and you multiply that by the APR, right, the annual percentage rate, and then you multiply that by the fraction of the year. Because remember, the annual percentage rate is the interest that's charged for the whole year for 12 months. But if we're only trying to figure out the interest for 1 month, then that means that we need to take a fraction of the year because 1 month is 1/12 of the whole year. Okay. So here's what we do. Okay, so we take $12,000, okay, and we multiply that by the APR, which is the annual percentage rate. So 12,000 times 10%, okay, that will give us a $120, okay, but that's for the whole year because the annual percentage rate is for the whole year for 12 months, right? So we then have to multiply that by a fraction of the year, right? So we take $12,000, multiply it by 10%, and then multiply it by 1/12. Okay. Now, another way of doing to multiply by 1/12 really means to divide by 12, right? So $12,000 times 10% times 1/12 will give you $100. So that means that for the first month, the amount of interest that accrued, another term, accrued means grow, right? Accrue, interest growing. The amount of interest that grew is $100, okay? So that means that if our payment is $200, then that means $100 of the $200 will go towards covering the interest, and the remainder will go towards reducing the principal. Okay, so in this chart we have $12,000 is the amount that's owed initially, right? Is the loan, okay, the principal, right? And then our monthly payment is $200 per month. So after the first month, right? What's the situation? Well, the $200 that we pay for the first month, $100 of that $200 will go towards the interest, and the remaining portion will go towards the principal. And so that means that at the end of that month, right, what is our principal balance? How much do we owe now, right? That means that we only owe now 11,900, right? Because $100 of the $200 was used to reduce the principal. Okay, so now at the start of the next month, right, how much is our principal balance? It's 11,900, right? So the amount that we owe now is 11,900. Okay, now let's go through the second month. We pay another payment of $200, right? But now here's the thing, how much of that is going towards the interest? Well, when we do our calculation now, it's not the 12,000, right? Because we paid down the 12,000 loan to be 11,900. So now when we do the calculation for the second month, we're going to take 11,900, we're going to multiply that by 10%, and then we're going to multiply that by the fraction of the year, right? 1/12. And then that means we're going to get $99. Okay, so now here's the situation. For the second month, the payment of $200, well, $99 of the $200 is going to go towards the interest, and then the remainder, which is $101, will go towards reducing the principal. So now at the end of the second month, that means that our principal balance is now going to be 11,799. Okay, so now at the beginning of the third month, then how much is our principal? How much is the money that is owed? Well, at the it's now going to be $11,799. Okay, now we do, for the third month, we do another payment of $200, right? And so how much of that is going towards the interest? Well, we do the calculation now, 11,799 times 10% times a fraction of the year, 1/12, and we get $98. All right, so now only $98 of the $200 is going towards interest, right? $98 go towards the interest, and then the remaining portion is going towards paying down the principal, which is $102. So then after the third month, what is our principal balance? Well, now our principal balance is 11,697. So do you see what's happening? With each payment, a portion of the payment is going towards the interest, and the remaining portion is going towards paying down the principal, right? Now, let's talk about some terms. This process is called amortization. Amortization. I know it sounds like a big term, but really, it's very simple to understand. What is amortization? All right, amortization. Amortization is the process in which part of each payment goes towards paying the interest, and the remaining part goes towards lowering the principal balance. And this is a perfect example of amortization. All right. Now, here's the thing though. The way that it was working was that the payment always had to be more than the interest, right? Because the payment has to cover the interest, right? And have an excess so that the excess can go towards the principal, paying down the principal, right? So now what happens though if the payment does not cover the interest? Well, in that situation, that would be called negative amortization. All right. Now, what is negative amortization? Negative amortization means it's a situation in which the payment is not enough to cover the interest. And so the amount of interest that was not covered gets added to the principal balance. And so in a situation of negative amortization, it means that your principal balance is actually going to be increasing rather than decreasing. Okay. So here's the thing. Here's the situation. If the payment is more than the interest, okay, then the excess will decrease the principal, right? And that's called amortization. Okay. Now, but if the payment is less than the interest, then the deficit, okay, the deficit will increase the principal, okay? But now, if the payment is exactly the interest, so if the payment exactly equals the interest, then the principal will stay the same, all right? You're not paying off any of the principal if the payment equals exactly the interest, all right? Now, let's jump into example number two. Example number two. We're talking, this example is about a student loan, okay? Now, in this example, let's say the student loan amount is $37,584, okay? $37,584 is the student loan amount in this example. Let's say the APR, the annual percentage rate, is 5.8%, 5.8%, okay? And so what is the interest per month on that student loan? Okay, so here's how we calculate it, right? Remember, we use this formula, principal times the APR times the fraction of the year. So therefore, we take the interest. And so the interest calculation is 37,584. We multiply that by 5.8%. So when you put that into your calculator, 5.8%, when you put it into a calculator, you put it in as 0.058, okay? That's 5.8%, 0.058. All right, so 37,584 times 0.058 times the fraction of the year, which is 1/12. So you times 1/12 and you get $182, okay? So that means the interest is $182 per month, okay? So now, here's the thing. We just learned about how, amortization and also negative amortization. And so here's the thing. If the interest per month is $182, okay, that's the interest per month. Okay, now if our monthly payment, like in this situation, if the payment equals the interest, then the principal will stay the same. So that means that in this situation, the interest that's owed every month is $182 per month, right? Now, if the payment is also $182, then that means you will never pay off the student loan, right? Because there's no excess that will decrease the principal balance. If you're just paying the interest, then that means you're just going to keep paying the interest forever. All right. So if the monthly payment is 182, then that means that you're never going to pay off the loan. It means that your total interest is going to be infinite because you're just going to keep paying interest and interest and interest, right? The total cost, the principal plus the interest, will be infinite. But now, let's say that you pay $200. Suppose that your monthly payment is $200. Okay, so the interest that owed is $182, but you're paying $200 a month. That means you have excess, right? So that means you're paying $18 extra, right? That $18 extra is going towards the principal, paying down the principal, right? But now it's only $18 it's only a small amount, right? So it will take you 41.3 years. It will take you over 40 years to pay off that student loan. All right, if you're only paying $200 per month, right? Because the amortization is like, because each time the excess is only a little bit, right? And so it take you over 40 years. The total interest will be 61,511 total interest. So that means that the total cost would be $99,095. Total cost. Now, let's say that your monthly payment though is $300. Okay, so that means that every month, right? $182 of the $300 is going towards the interest, and the excess, right, which is what, $118 is going towards paying down the principal balance. All right, so that means in that situation, it will only take you 16.1 years to pay off the student loan, right? Big difference, right? And in that case, your total interest would be 20,291, and that means the total cost, right, the principal plus the interest of this loan would be 57,875. All right, but let's say that you're able to pay $500 per month, right? Then in that case, it will only take you 7.8 years to pay off the loan, right? And your total interest would only be 9,233, and so that means your total cost, principal plus interest, would be 46,817. All right. Another example. Let's do, if you were to pay a monthly payment of $750 per month, $750 per month, then in that case, it would only take you 4.8 years, right? So within 5 years, you would have your student loan totally paid off, right? And your total interest would only be $5,557, and the total cost, principal plus interest, would be $43,141. Okay, so what's the key point? What's the key point to this? The key point is this: it may sound nice to pay less per month, but it will cost you a lot more in the long run. In the long run, it will cost you a lot more. So you definitely want to pay off, pay off. So now here's the thing. Let's jump into example number 3. Now, these first 2 examples were examples of where we were borrowing money, okay? And we said how, interest is the money you have to pay for borrowing money, but also interest is the money you earn for lending money. So let's do an example where we're lending money. Now, in example number 3, we're talking about a savings account, okay? A savings account at a bank, okay? A bank savings account. A savings account, and now different banks, and different types of accounts, will have different terms in terms of interest, okay? So like, for example, there are a lot of checking accounts that don't pay any interest at all, right? But there are a lot of savings accounts that do pay interest, and it varies from bank to bank, right? And also it can change over time, right? Depending on what's happening with the Federal Reserve and all that kind of stuff. But let's just, for this example, let's say the APR is 2%, okay? So let's say in this example, savings account at 2% APR, all right? And by the way, like Capital One, for example, right now, all right, and it is October 2022, Capital One savings accounts pay like 2.2%, okay? So just to kind of give you an idea. But there's some other banks that pay like 0.01%, all right, on their savings accounts, okay? So it varies, all right? So as a little side note, you have to shop around to see, what, and you have to compare different, bank savings account percentages. So in this example, we're saying savings account at 2% APR, all right? Now, And let's say that, just to keep the numbers really simple, let's say $10,000 is the amount, right, that you deposit into the savings account. All right. So you deposit $10,000 into a savings account that pays 2% APR, all right, annual percentage rate. So at the end of the first year, how much money will you have in that account? Well, you take the 10,000. Now remember, it goes back to the percentage. I mean the formula for calculating interest. You take the principal times the APR times the fraction of the year. Now in this case, we're calculating it for the whole year. So the fraction of the year will just be 12 over 12, right, or 1, right? So basically you could just do principal times APR, right, to calculate the interest for the whole year. So $10,000, all right, and then you multiply that by the 2%. Now, how do you multiply by 2%? And when you use a calculator, you put it in as 0.02. All right. So $10,000 times 0.02, and you'll get interest for the year for $200. $200. So that means at the end of the year, your bank account will have grown to 10,200. Now, so at the start of the second year, you have 10,200. So at the end of the second year, how much money do you have in that account? Well, you do the calculation again and you do 10,200 times 0.02 and you get $204. And so that gets added on. And so now your account has grown to $10,404, okay, by the end of the second year. And then at the beginning of the third year, you now have $10,404. And so now for the third year, you do the calculation and your interest for the third year is 208. And so then that means your account has grown to $10,612, right? And then for the fourth year, the interest now is 212. The fifth year, 216. The sixth year, 221. So do you see how the interest is increasing? And the way that the interest is increasing is because of the concept of compound interest. Compound interest. What is compound interest? Compound interest is the process in which you are earning interest on the initial amount, and you are earning interest on the interest that has already been paid to you. All right. So you're earning interest on the initial amount and you're earning interest on the previous interest that you've earned. Right. So it's an amazing concept, because it shows you how, due to the power of compound interest, your balance will grow at a rate that is increasing every year, right? The first year we only increased it by $200, but the second year it increased by 204. Then the third year 208, then 212 for the fourth year, then 216 for the fifth year, and then 221 for the sixth year, right? And keep in mind, this is a very low interest rate. Now, when you do this situation, when you talk about, because I do real estate investing and private money lending, and we're talking about like rates of like 15, 16, 17%, right? And in those situations, it's even like the power of compound interest. It's just even so much more, right? But and so now here's the thing, when you put money into a bank account, you are essentially lending money to the bank. Depending on the bank and the type of bank account, you can earn interest. All right. So the key point, what's the key point? The key point is this: interest can work for you or it can work against you, right? In the first two examples, these first two examples were about borrowing money, right? And when you borrow money, you have to pay interest. But when you lend money, you earn interest. All right. Now, let's jump into two quick exercises as we wrap up. All right, exercise number one. Let's say you have a $5,000 investment and you add $100 per month to the investment, right? And let's say the interest compounds annually, And let's say that the APR, the annual percentage rate, is 8%. All right. Now, here's the question. How much will you have after 5 years? After 5 years, how much will that investment be after 5 years? Now, to do this exercise, let's use a compound interest calculator, all right? And we can easily get one online, all right? So let's go online and use a compound interest calculator to do this exercise, all right? We'll go to Google and we'll type in compound interest calculator. And let's use the one from investor.gov. And okay, so now we're here and let's put in these amounts. Now, the initial investment we said is $5,000. The monthly contribution we're saying is $100 per month. The length of time in years, let's say we're saying 5 years because we want to figure out what is the balance after 5 years. And the interest rates, right? The annual interest rate, the APR, is 8%. All right. And let's calculate. And we're saying that it compounds annually, right? Compounds annually. All right, so let's calculate that. And let's see. And we get $14,386.56. And now, exercise number 2. If you borrow $6,000 to pay for a car with an APR of 8%, how much interest accrues in the first month? All right. So this one, we just use a regular calculator to do this one. So now, remember, what is the formula for interest, right? Remember, the formula is the principal times the APR times the fraction of the year, all right? So let's do this one. So let's see. Calculator. So now, we borrow $6,000. So we put $6,000 times APR 8%, right? So remember, when you put it into your calculator, 8%, you put it in as 0.08, okay? And then we get an answer. We get 480, but that's for the whole year. We want to figure out how much interest accrued in the first month, right? So it's 480 for the whole year. So now we got to multiply that by the fraction of the year, right? Now, so the fraction of the year is 1/12. Now, another way to do it, is just to divide by 12, right? So we'll divide by 12 and we get $40. So if you borrow $6,000 to pay for a car with an APR of 8%, how much interest accrues in the first month? The answer is $40. All right. Awesome. Awesome. If you have any questions, please drop your questions in the chat box below. And by the way, a lot of this material, as well as the examples, are taken from this book called How to Adult by Jake Kuzno, Personal Finance for the Real World. This is an amazing book. You can get it off Amazon. I highly recommend this book. All right. All right. Thank you for watching, and I'll see you next time on the next video.